Disclaimer: stock trading is inherently risky and the users agree to assume complete and full responsibility for the outcomes of all trading decisions that they make, including but not limited to loss of capital. Matthew, chapter 25 verse 14-30, "For it will be like a man going on a journey, who called his servants and entrusted to them his property. To one he gave 5 talents, to another 2, to another 1, to each according to his ability. Then he went away. He who had received the 5 talents went at once and traded with them, and he made 5 talents more. So also he who had the 2 talents made 2 talents more. But he who had received the 1 talent went and dug in the ground and hid his master's money." For today's video, we are going to talk about Bollinger Bands. Bollinger Bands is a technical analysis tool to generate oversold or overbought signals and was developed by John Bollinger. 3 lines compose Bollinger Bands: a simple moving average, or the middle band, and an upper and lower band. Upper and lower bands may be adjusted from their default value of 2 standard deviations above and below the 20-day simple moving average. An overbought indicator may be present when the price keeps bumping up against the higher Bollinger Band. The price may be sending an oversold indication if it keeps testing the lower range. A Bollinger Band is a technical analysis tool that consists of a series of trend lines. They are shown as 2 standard deviations away from a security's price, both favorably and negatively, and may be changed to user preferences. Bollinger Bands were created by technical trader John Bollinger and are intended to help investors detect whether an asset is oversold or overbought. Bollinger Bands is a well-known strategy. Many traders feel that as prices move closer to the upper band, the market becomes more overbought, and as prices move closer to the lower band, the market becomes more oversold. When employing the bands as a trading technique, John Bollinger has a set of 22 guidelines to follow. Bollinger Bands revolves around the squeeze. Squeeze happens when the bands squeeze the moving average. Traders believe squeezes indicate low volatility and upcoming trading chances. Conversely, the broader the bands travel, the higher the risk of volatility reduction and trade departure. Not trading signals. The bands do not indicate when or which way the price may change. Approximately 90% of price action occurs between the 2 bands. Any breakout above or below the bands is significant. The breakout is not a trading signal, and many investors mistake that when the price hits or exceeds one of the bands as a signal to buy or sell. Breakouts provide no clue as to the direction and extent of future price movement. What do the Bollinger Bands reveal? Bollinger Bands provides traders with an indication of the market's movement based on price. It employs 3 bands: 1 for the upper level, 1 for the lower level, and 1 for the moving average. When prices approach the upper band, this suggests that the market may be overbought. In contrast, a market may be oversold if prices move closer to the lower or bottom band. Bollinger Bands can be a useful instrument for speculators in determining the relative level of an overbought or undersold stock, as well as when to enter and exit a position. Certain aspects of Bollinger Bands, such as the squeeze, work well for currency trading. Buying when stock prices cross below the lower Bollinger Band often helps traders take advantage of oversold conditions and profit when the stock price moves back up toward the center moving average line.
That's all. Thank you for watching. I hope you learned many new things about the stock market. Kindly subscribe to our channel and click the notification bell. Also follow us on our Facebook page to learn more about the stock market.